Kim, now that tax reform is about 2 years old, I think we've been seeing companies repatriating earnings and profits from offshore, either because of the 965 event in 2017 or even new earnings and profits post-18. What sort of state tax considerations should they be thinking about?
So as you know, previous distributions from previously taxed earnings, there's no tax consequence from a federal income tax perspective. However, for state purposes, there's a little bit more that we need to consider, especially when we're working with distributions that are coming through a multi-tiered org structure. Specifically, so if you have a distribution comes back into the U.S. And it was previously taxed under IRC 965, that distribution of those earnings would not be subject to tax, and as it moved through the structure, the tiered structure, it would eliminate amongst itself. However, if a state did not conform to 965 or they didn't previously tax those distributions, they would then be subject to tax. In addition, if you have a state or a distribution to a subsidiary that wasn't a state that the U.S. shareholder who originally received the 965 income inclusion was not in, you could have some state leakage due to partial DRDs or no DRDs. The other thing to think about when we're talking about a tiered structure is whether or not when the distribution moves through that tiered structure, if we would have an issue with that dividend being treated as a qualifying dividend and be allowed a DRD if it was applicable.
Right, makes sense. So it sounds like we have a lot to track and a lot to keep track of from a state perspective on these distributions, especially pre-2018. How about distributions in 2018 that aren't out of previously taxed earnings and profits?
Yeah, so for distributions that had not been previously taxed, for federal purposes, they are afforded a 245 deduction, and so that income is not subject to tax for federal income tax purposes. So really it comes down in the state perspective is whether or not the states would conform to 245 Cap A. There is not explicit conformity to Section 245 Cap A. However, what we would do is we would look to the state's general conformity to the Internal Revenue Code. We would also look to see how the state defines state taxable income, whether it starts with line 28 or line 30 after special deductions. And then from there, if they don't conform to 245 Cap A, then we would look to the dividend received deductions. Similar to what we discussed in a tiered partnership a few minutes ago, we'd still want to make sure that we're flowing up that distribution and that we're tracking it to make sure that it's appropriately accounted for in the various states as it goes through the chain. The other thing that I would just like to point out is that states are beginning to kind of stretch their hands to see if they could get additional revenue. For example, Wisconsin is disallowing dividend received deductions for any distributions from corporations that are not issuing common stock. And so we're just seeing a lot more activity around that. And then secondly, to the extent that there's international structuring going on, we're also seeing some deemed distributions getting taxed in a state that specifically doesn't conform to the federal tax reform provisions.
Okay, so it seems like there's a lot of work still to go on distributions, either actual or deemed. Thanks, Kim, for talking about distributions on the state tax side of things today.
Sure thing. Thanks, Nick.